Now, Andy Barker, president of Houchens Insurance Group, will be sharing a few words. Good morning, Andy.
Good morning. Can you guys hear me?
Yes, we can.
Perfect. Perfect. Hey, I want to welcome everybody. Wanted to thank Baldwin specifically for partnering up with us on this. By all means, this is a question that's top of mind for so many of us right now. We're hearing this from several of our clients and prospects, and just really truly understanding it. And we have gone to some of the best in the industry to help understand that. Obviously, we all know this is unprecedented times and creates a lot of speculation, and we want to present facts. And by all means, where we take a lot of pride in being insurance brokerage that knows one of the best in the business of what we do, we can't be an expert at all. So we've come and partnered with Baldwin, which has been a dear partner to us, and want to thank them for their time and thank all y'all for attending. So with that being said, I'll turn it back to you guys.
All right. Well, again, good morning, everyone, and welcome to the webcast, CARES Act Paycheck Protection Program Forgiveness. Over 1.6 million businesses and nonprofits receive funds from the Paycheck Protection Program as part of the CARES Act to keep workers employed amid the pandemic and economic downturn. The Paycheck Protection Program loans give organizations the opportunity to have the loans forgiven if borrowers maintain their payroll and comply with specific reporting requirements. During this webinar, we will walk you through the processes and documentation best practices to maximize the opportunity to have your Paycheck Protection Program loan forgiven. Today, our presenters are Baldwin member Lisa Foley, CPA, CGMA, and Baldwin accountant Matthew McCurahan. And at this time, I'm going to give the floor over to them.
Thank you, Leslie and Andy, for the introduction. I'm glad to partner with you all and provide this information. We decided as a firm that we wanted to really dig in and figure this out and help our clients and prospects as well to understand and take the most benefit from the availability of this program. As Leslie mentioned, the CARES Act was passed back on March 30th, and we had the first round of applications that went through, and pretty much I think it closed down on April 12th, April 13th. So we went through $349 billion in that first allocation. They just released another $320 billion to the program, with $60 billion being earmarked to smaller financial institutions so that we can guarantee that some smaller banks will have access to getting their clients processed. But to be honest, our experience to this point, we have had more success working with the smaller banks on the first round than we did larger banks. The larger banks tried to build a robotic process, an online version, and that is that caused they didn't get up to speed as fast. And then once they did come online, that's why the funds went really fast. So that is why they did earmark $60 billion to the smaller banks, and hopefully that will keep the smaller businesses the availability for them. So even though we're going to spend today mostly talking about the forgiveness, which applies to a lot of people that were in the first wave, I know people are still applying. And if you have some questions on that, Matt and I will be happy to answer those as well at the end of the presentation. It did open back up, the application process, Monday at 10:30. I believe I heard reports that the site crashed at 10:31. So again, it's just been a start and stop kind of process. And I know the banks are working very hard to get as much process as they can. So if you're going through the application process now and you're wanting to go ahead and understand the forgiveness part, by all means, ask some questions about that at the end. We'll be happy to answer. And I would just say your banking relationship, I feel like CPA relationship's important, your insurance is important, that banking relationship and leaning on that during this time should help, because the processing of the application really is in the bank's hands. So with that, we'll get started and move into our first screen, just so that everybody knows. The CARES Act was passed at the end of March, March 30th, and they issued at that time some interim regulations as of April 2nd. And they stated on April 2nd that they would be giving us additional guidance in regard to the loan forgiveness. But as of, we did this webinar last week, as of today, we still have not seen that. So you're going to hear a lot of things that we're going to give our thoughts and opinions on, but we are still waiting on some good concrete guidance. I know Matt and I talked last week. Matt, the CARE Act is how many pages long, if you can remind me, and how much was dedicated to forgiveness?
Yeah, there was approximately almost 200 pages of statutes that were put into place, and there was about a page and a half on forgiveness. And then on the interim regulations on April 2nd, it was about a 31-page document, and there was about a half a page worth of forgiveness.
So that being said, we are operating on very little information, and we have tried, from our perspective, we have studied the Act ourselves, and also, studied other sources of information we feel comfortable with, and kind of mesh those together to what we think the best approach is in looking at your forgiveness. And as we get further guidance, we will share that with all the webinar participants and make sure you're up to date, or if information we've given you is changed or has updates, we'll make sure to get that out to everybody. So just kind of in guidelines, your forgiveness amount can be up to the full amount of your loan plus the accrued interest. So we are making the assumption we're going to need to use all the loan proceeds for the forgiveness. So that's kind of how we're going into this and looking at it. Just keep in mind, what doesn't get forgiven turns into a loan after the 8-week period. And that is a 2-year loan, 1% interest. And most of the loan documents that we have seen to this point, they're written where they provided you an amortization on the loan on the full amount. And those payments are deferred until December. So if you have your loan documents, you probably have seen an amortization schedule that really amortizes the full amount of the loan from December through a year and a half, basically. Our understanding from talking with numerous banks is that once the forgiveness amount is calculated, that they have the ability to change that amortization amount to match only the part that you need to pay back over the year and a half if some of it's not forgiven. And honestly, we do expect, depending on the amount of loan you requested, there is a good chance, hopefully a small portion, if you plan appropriately, could become a note and not forgivable. So we're going to go into the details of that as we move on. So some other guidelines. Want everybody to think you must use the loan proceeds for payroll cost, interest on mortgage obligations, for rent payments, and utilities are the allowable costs that the monies can be used for. Your employee and your compensation levels must be maintained, and that second bullet point there is where we're going to get into a lot of detailed calculations that Matt's going to walk us through a little bit later. So they want you to be back at the place when you were in full operations. They want the same number of employees and the same types of compensation being paid, is the goal of this program. I look at it as they really want the workforce back in place and ready to go when the economy can take off and we'll have this behind us. What we have seen and everything we're expecting is that the loan application on the front end, albeit it was a little bit hectic in that we were getting changes every day. They were changing what could be included and what couldn't on the application. The application itself was not very difficult. It was the lack of information on what was to be included that made it a little bit more hectic. The application itself was not hard. It was basically figure your payroll cost, times 2.5, an annual payroll cost divided by 12 to get a monthly average, times it by 2.5, and you're good to go. We expect that the scrutiny on the back end of this loan, improving your forgivable amount, is going to be much more complex and much more scrutiny is going to go into it. We really didn't have a lot of trouble getting applications processed once we knew what each bank needed. That was part of the problem, is every bank was asking for different things, even though they maybe weren't required to. And I guess what I would like to say about that, so everybody understands, the bank is not getting funded for these loans immediately. The banks are having to fund these loans out of their current capital. So that is making, that's hard. And some banks have said, we're done. We don't have enough capital to put out any more loans. So that has made it very difficult. Some small banks were not SBA approved, so they had to go through the process of getting SBA approved to be able to even help their clients with this. So there's been a lot of, the financial industry institutions have really had to pivot and meet their customer demand. And it's been a tough month for them as well. But I think they're coming through it, and there are a lot of online that like I mentioned before, we had some trouble with that, but nobody has their forgiveness scrutiny defined yet, really. We have these general rules we're going to talk about. So I just want everybody to be prepared. The level of detail on the back end, I really think, will be a lot more. So overall, when you're looking at your loan and trying to figure out what your expected forgiveness amount is, it should be the sum of all your forgivable costs. So that's going to be your payroll, your interest, your rent, and utilities that were incurred in the 8-week period following the date of your loan. The date of the loan is very important. This 8-week period starts on the origination date of your loan. So always look at your loan documents, see what date they are. It should be the date you're signing. I've had a few instances, maybe that was backdated a little bit, but most of the time it will be the day you get the money and the day you sign. But just always look, and we're going to share a spreadsheet tool with you in today's presentation and afterwards, and we have a place for you to document that. But that's when your clock starts on counting these expenses. As a reminder, your payroll costs will include wages, bonuses, cash tips if you're in a restaurant industry, that are paid to your employees. Keep in mind that payroll costs can only include employees up to 100,000. So if you have an employee that makes 150, you can only count the prorated amount of their cost up to like they are making 100,000 a year. So for instance, we've kind of given you the example. If you've got somebody over that amount, you're really only going to be able to count $15,385 of payroll for them. And that was just a product of 100,000, getting the weekly pay amount, timesing it by 8. So kind of keep that in mind. You can also include healthcare costs. This is your group healthcare. Health, dental, vision is what we believe is available in that. Those costs, and those are in addition to the 100,000. So kind of keep that in mind. These benefits of healthcare and retirement, they do tack on to this $15,000 limit we've just mentioned. Contributions to retirement plans, that's going to be the employer match, is what you're able to count your allowed payroll cost. And then from a Kentucky standpoint, some states are different, but for Kentucky, we have focused on the only employer tax that is allowed is the state unemployment in calculating your total payroll cost over these 8 weeks. And that was the same definition that was used on your application on the front end. So just kind of keep in mind those do match. If you made a mistake on your first application because the rules weren't as clear then, we do feel like whatever meets this definition now, you can count. So that is going to help some people meet their cost a lot easier because maybe they undershot their cost on their application because some of this wasn't clear. So just kind of keep that in mind. So I want to go over a little bit about the open questions and probably I've not looked at some of the chat, but if I did, I'm sure some of these are questions everybody is having. When we talk about interest, what all can we include? I think that the bill says mortgage interest, but everybody's asking, but what about our equipment in the construction industry and things like that? I have seen one spreadsheet that seems to allow equipment as interest on those loans, but we are still awaiting guidance on that and to get that more defined. From the retirement cost amount, we've had a lot of questions. Can we front load our company match? Can we go ahead and fund our profit sharing if we do that once a year during these 8 weeks? And just to be honest, we don't know. Obviously, those appear to be an allowable expense, but are they going to really let you front load that information? So kind of we'll be on the watch to clarify that for everybody. The other thing that's coming up on a daily basis is if you've got people off work, but you've got to meet these FTE numbers that Matt's going to go into detail about. Can I hire a family member? Can I increase rents? And normally those rents are paid to a related party. As the act is written, there is no rules that say we can't do those things, but we really do expect some clarification on that, because that could be kind of a rampant area that people could really make a lot of changes. So we will be on the alert to keep everybody informed about that, but it just, as of right now, we just don't know. The other big topic that is out there about the loans, what does utilities include? Is this a utility in the sense that it has to be provided by a public company and is subject to PSC regulation? We don't know. And if that doesn't have to be that way, which that's normally going to be your water, electric, gas, sewer type items, can internet, cell phones, cable, trash be counted in addition to those normal things? We just don't know yet. So we hope this guidance we've been waiting on since April 2nd will clarify that for us, but we have not seen that yet. One of the other big things in the statute that's a point of debate is it does say that the cost must be incurred and the payment made. So we don't know. Matt will talk about this a little bit. We are encouraging people. We kind of take that it's going to be a type of a cash basis type calculation. So you are going to have to think about your payroll date when it's hitting in this 8-week period, and you may possibly have to, if you're on a 2-week pay period, if it really truly has to be the payment is made, you may have to, in that final week of your 8-week period, go to a weekly payroll to cut the checks in order for them to count. I think we'll have time to plan for that. I know a lot of our clients are in week 3 of their 8-week period already at this point, but we still have 5 weeks if we can get some concrete guidance on what this cost incurred and payment made. I've also had that question come up about, when the pandemic came about, they kind of pulled back on their rent payments. Can I make those up now? Well, I don't know. Was that incurred for March rent, but you didn't get your loan until April? Maybe the way this reads, that won't count. So we're just really still a little bit in the dark on how that works. The other big item that a lot of people have talked about is this loan tax-free? And the Act says absolutely yes, it will be cancellation of debt income, but from an IRS standpoint, it will be tax-free. But the flip side of that is there's already in our IRS section that says if you pay expenses with non-taxable income, those expenses then are not deductible. So if they apply that to this income, yes, it's tax-free, but however, you may not get the expenses that you paid with it as a deduction. So in essence, it takes away that. So just kind of keep that in mind. We have no guidance on these issues right now, and we will work our best to keep everybody informed once we get further guidance on this. And we expect that we really hoped we would get it last week and still haven't seen it. So as we move into the meat and the details that Matt's going to take over, just kind of in thinking about the forgiveness, you need to think of it in three main areas. So we've got what we call the 75-25 rule, meaning that you've got to spend 75% of the monies on payroll and 25% on non-payroll items, the rent, utilities, and interest that we've talked about. You've got to look at your full-time equivalents. You've got to keep track of that and make sure you're meeting those to some comparison periods. And then you've got to prove that your employee and salary wages haven't dropped. And that's the third bullet point, in my opinion, is the tricky calculation that we really need some good guidance on. But we're going to walk you through how it reads. It's going to be a little tricky to meet that one in a full amount. So I think we are going to see, unless you make some adjustments, and as it reads right now, you have to expect that you may have a little bit of unforgivable amount calculated in bullet point 3. And we've got some tools to help you work through that. So I'm going to ask Matt to jump in with the detail of these 3 rules and go through those with everybody.
Thank you, Lisa. Appreciate everyone being on the call this morning. Before we dive into the details here, I just want to make sure everybody understands the chat feature in the Zoom call today. Please feel free to ask questions. We're going to go through some heavy lifting of some calculations that are going to be kind of hard to explain over a call, but I will definitely do my best to interpret those calculations and provide you with the necessary information. But please feel free to ask questions as we go, and then we will have a time for Q&A at the end of today's session. And if we don't get through all the questions, we'll make sure to put this up on our website and get those questions answered for you. So with that being said, we're going to jump into some of the provisions here that are going to be much needed calculations in terms of our loan forgiveness amount. That being said, Lisa mentioned the 75-25 rule. And so this is kind of the first one that you're going to want to look at. And so obviously we're going to keep track of 8 weeks worth of spending for our Paycheck Protection Program loan. And so once we get those amounts, those costs that have been at this point, what we believe to be paid, but we're also waiting some guidance on what costs incurred means. So if we're taking the approach of what has been paid, that would be our total forgiveness amount that we can go and base these reduction calculations off of. And so just an example here, at least 75% of total forgivable expenses must be spent on payroll. So you kind of got 2 examples here. The one example on the left, say your loan amount $150,000. And after we've looked at our cost, we go through and calculate percentages of where we spent our money. So in the first example there on the left, we spent $120,000 on payroll costs. Now remember that includes other items other than just gross wages. So those things are all included in that number. We spent 80% of the loan proceeds on payroll. And so we would have met that 75-25 rule. And so that then allows us to kind of go look at these other reductions and see what is our reduction amount going to be based off these other provisions. But we're definitely only going to want to reach the 75-25 rule. And so you can see in that first example, we spent $10,000 on utilities and then $20,000 in rent. But overall, our allocations match up with what the requirement needs to be. The example on the right, we didn't get our payroll costs all the way up to the 75%, and we only started and got to 66.67%, that $100,000 number. And then we spent $15,000 on utilities, and then we spent $35,000 on rent. And so at this point, we believe there still is going to be a allowed forgivable amount up to your payroll costs. And so it's not an all or nothing. But that being said, we wouldn't be able to then come along and be able to use the utilities and rent as a forgivable amount as well, because we didn't meet that 75-25 rule. And so just to note, this 75-25 rule was not in the initial CARES Act. It was in the interim guidance that was provided on April 2nd. And so that when I mentioned that there was 31 pages in that interim final reg, that half a page that we mentioned was unforgivable was entirely in relation to this 75-25 rule. And so this is a big key component that they feel the intent of the CARES Act, the way they talk about it, was intended to make sure that most of the costs were used for payroll. And so they've come back and made this 75-25 rule to make sure at least 75% of the loan proceeds will be used on payroll. Moving into the next kind of provision or requirement here is your FTE calculation, and we kind of call this the FTE assessment. And so you're going to have a couple options here, but first thing to note is as we're going along and recording our costs for our 8-week period, after we have gotten the loan proceeds, we're going to have to keep track of our full-time equivalents. And so the SBA comes along and defines our full-time equivalents, or our FTEs, as anyone who works over 30 hours or more in 1 week, or 60 hours in a biweekly payroll situation. And so that 30-hour is key because that's going to be part of the calculation to get you to your full-time equivalents. And so you'll calculate your 8-week average for your covered period, which is the 8 weeks after you have received the funds. And then you're going to compare that to 2 different time periods. You have 2 options. Option 1 is to look back into 2019 and look at your average. This is per pay period. So just remember, it's per pay period, not, it says month, but it is the pay period in each month. And so you look at your pay periods from February 15th, 2019 to June 30th, 2019, and then come up with your average FTEs for that time period. And so that's going to be information that you have available. It's just going to take some time to go back and calculate those FTEs based off that 30-hour benchmark that the SBA has stated for your full-time equivalent. So that's option 1. And then option 2 is a time period from January 1st, 2020 to February 29th, 2020. And so you would do the same type of calculation based off the pay periods during that audit time frame, and you would come up with your average FTE there as well. And so the goal of this calculation is to be at or above 1. So a quick example, if you our average 8-week over our covered period is 20 full-time equivalents, and then we look at both options, and perhaps option 1 is 19, and so we would have we would be good. We'd have a check mark for that one. So we had 20 during our 8-week covered period, and our first option was 19, so we would be fine. But let's say we had 20 and option 1 was 22. Well, we're already down 2 full-time equivalents, and so that is prorated, and that's going to be a calculation there. So you would take your 20 that you have for average of 8 weeks divided by your 22 to get a percentage, and then the remainder minus 1 of that percentage would be your actual non-forgivable amount. And so using the example of 20 on our average, say option 2 was 18. So option 1 was 22, but option 2 was 18 FTEs. Well, we get to take the better of each option. And so it's really important to calculate both time periods, unless there are some understanding circumstances where perhaps in 2020 we've grown substantially, and we know that in 19 our FTEs were probably half of what it is now in 2020. But it's important to note that if those circumstances don't exist, we need to do this FTE assessment. And so I kind of want to stop there real quick, because there is a provision in the statute that states during the time period of March 1st till 30 days after the enactment of the CARES Act. And so that was actually 2 days ago, the ending time period. So March 1st to April 27th, if you have done anything with employees, whether that be furloughed or laid off, there is a provision that says that if you bring them back and restore wages to as of before 6/30/2020, then your FTE calculation is kind of null and void. You've restored all your FTE requirements, and so you won't have to go through and actually do this calculation because you've restored all your full-time equivalents. But it's important to note that when you go actually look at the CARES Act, a lot of people and a lot of information I've been seeing states that it is for every scenario, every circumstance, that if I bring employees back by 6/30/2020, then I'm good to go. And that's not necessarily the case, because they did define that time period of when you have done things with your employees. So for instance, if things were done through January and February, us bringing those full-time equivalents back up would not help in that scenario. It is only for things that were done through March 1st till 30 days after the enactment of the CARES Act, which would have been 2 days ago, April 27th. And so, but when we start looking at the reduction in wage provision here, you're going to want to bring those employees back as soon as possible to help try to restore these wages, because you're going to see that the way the CARES Act is written is almost a hindrance to us, because you're going to be comparing your 8-week cover period back to your full first quarter of 2020 wages. And so you can see just by comparing 8 to what is actually 13 weeks in your first quarter, they're going to come up with a reduction amount just based off of that. So you're going to want to bring your employees back as soon as possible. So that's kind of it with regards to the FTE calculation. Now we have a tool that I'm going to show here in a little bit that actually walks through and helps you plug in these numbers to be able to get your averages, and then will actually help calculate your reduction amount as well.
Matt,
so look out for that.
one thing we might want to mention there is that 30-hour rule to becoming an FTE may give you the ability to do some planning, because if you've got someone that's working 35 hours and you've got somebody that's working 27, you may be better off to pull one person down to 32, move the 27 hour up to 30, because then they become a full. Whereas if you've got people under the 30, they go into a pool and you divide it by 30 and come up with a prorated number for those people. So if you've got the ability to play with people's hours, there is the opportunity to do some planning to help yourself meet these FTE numbers.
Very good point. Very good point. With that, we'll kind of walk into what we feel is the most crucial calculation, which is the 25% reduction in wage requirement. So as I mentioned, the CARES Act actually states in the original document that you are to take your 8-week earnings per employee. And I want to stress per employee, because if you don't do it per employee, you're kind of losing out on your planning, that you have the ability to switch things around here moving forward. So it's important to do it per employee, but you would take your 8 weeks and then compare that amount to your 13 weeks in the first quarter of 2020. And you're going to get a reduction in wage calculation. And so we've put a little bit of a snippet here from our tool to help our clients and prospects be able to basically come up with. And so I'm going to try to work left to right. And I know there's probably a lot of questions, so I'm also giving a good amount of time for you to look at it. And I'll try to move slowly from left to right. But let's use employee 1 as an example. You're first going to want to look at your 2019 annual compensation. And so you're going to want to put in their amount of gross wages in that first column. The reason you're going to look at that is because if you look at employee 2, and you can see that was $325,000. If you're over that $100,000 cap that we talked about was on the front end when we applied for our loan, we could only take the average annual salaries up to $100,000. So we were capped there. So employee 2 would not be in this calculation because his amount of wages earned over our 8-week period is not going to be reduced. It's actually going to be enhanced or straight even because of the $100,000 cap. So he would be excluded. That's why you're going to want to look at your 19 annual compensation. And then you can see the next column, it's excluded due to the compensation over 100,000, like we mentioned, or the reduction is less than 25%. And so that example is in employee 3. But I'm going to skip over to the next column, the year-to-date gross wages earned as of March 31st. And so for employee 1, you're going to drop in and grab a payroll summary or a payroll journal, whatever your report looks like, and you're going to grab their first quarter wages for employee 1 and drop it into that cell. And in employee 1's case, it was $10,000. And then for ease of calculation purposes, we went ahead and added another column, the next column over, year-to-date gross wages earned as of the date of loan disbursement. So if that was 4/15, you would put 4/15 in there. And so that's a different number. There's probably 2 extra pay periods if it's biweekly. or excuse me, weekly. There's 2 extra pay periods. And so you can see for employee 1, it was $11,000. And that column is important because the amount earned during the covered period is calculated off that column. And then you go to the last column there, which is a column that we're not necessarily going to know right up front, but we can certainly help you get a good expectation using your first quarter wages. But that year-to-date gross wages earned as of the end of your 8-week period for employee 1 was $17,000. And so you can see the next column, amount earned during the covered period was $6,000. Now here's where it gets tricky. The statute states that you have to take that $6,000 and compare it to the $10,000. And so when you do that, you're looking at a 40% reduction in salary and wages. And so that's over the allotted 25%. The statute states that you can have up to a 25% reduction in wages. And to be honest with you, we feel here at Baldwin, Lisa and I have had extensive conversations about, but that 25% we think was an intent to cover the disparity when looking at 8 weeks versus 13 weeks. But when you do that, they're still off by about 13%, because if you do the math, you're going to be already at a 38% reduction in salary and wages. And so how this reduction works is we're allowed the 25% reduction, but we have a 40% on employee 1. So the difference of that 15% is going to be part of our reduction amount. So you would take that 15% difference and multiply it back to your first quarter wages of $10,000 to get your reduction amount of $1,500. And so I know that is a lot of heavy lifting and a lot of calculations. And so luckily it's a little bit of plug and play. We've kind of geared our spreadsheet to be able to help you just to be able to plug in numbers, and then the reduction and then the reduction amount will be self-calculated to help our clients and prospects move forward.
And this is one area we really hope we get some clarification on. You know, I would say that there have been several cases where we had changes on the application process where Congress says that was not our intent. So we would love to see them come out and say this was not the intent. We've tried to think of why they would have said this. Of course, they want to be making sure that employees have cash in hand and are spending it to help stimulate the economy. So was that their intent, for us to make sure we pay our employees a little bit more during this time frame? Or, you know, or was this not, they really just didn't think this calculation through? But the fact that you're making us compare an 8-week period to a 13-week period, the math just doesn't work. And so there has been no guidance on how or if they're even going to correct it. So this part has been very puzzling to everybody that has studied it, because it just doesn't mathematically make sense unless their intent was for everybody to try to pay their employees more during this time.
Very good points, Lisa. And so when you're looking at that far right column and that reduction amount of $1,500, what that's stating is technically we need to go back and pay that employee to eliminate that reduction. We're going to have to give them an extra $1,500 over the 8-week covered period. So that's one way to look at it. Or the other way to look at it is that's just going to be part of our reduction amount. So we'll have our total forgivable expenses, but it's going to be reduced by these numbers in this column. And so there's two kind of ways to look at it. One, we can kind of plan ahead and get things to the employees, or just note that we will just have to pay some more back at the end of our 8-week covered period. So I'm going to move a little bit here, go to our next slide, and it's actually going to be our forgiveness calculator is kind of what we've called it. And so obviously we've noted that this is subject to change, but I'm actually going to switch screens here and share the spreadsheet. So I'm hoping everybody can see the spreadsheet, and Lisa, please chime in if you can't. But that being said, this is an example we've put on here. It is the perfect example. You always kind of start with those to see what it looks like, and then you can always play as you go. But as Lisa mentioned, the loan amount, your loan origination dates, these are all going to be filled out up in here in your top left-hand corner. And so those are going to be important because that's going to be geared towards your 8-week spending period. And so we've kind of calculated the weeks, And you can see we would definitely recommend doing this as you go. So I know we're kind of, if you've gotten your loan earlier, you're probably in week 2 or week 3, so we might have to do a little bit of legwork to get caught up. But you're definitely going to try to look at this as a week-to-week basis. That way you can keep track of all of these provisions that could potentially be reductions in the amount that you get forgiven. And so just looking at this example, they received the same loan amount that we talked about in our previous example of $150,000. And so we've kind of worked out the math where the gross payroll with employee benefits, which is group healthcare, retirements, and your Kentucky state employment in this example, came out to $120,000, just like in our first 75-25 rule example. And that being said, we've kind of met that rule. So we've spent about 80% of our loan proceeds on payroll. And so one thing this example is geared towards is using all the proceeds. And I know Lisa had mentioned that. So this changes a little bit when you don't use all your proceeds. And so your forgivable amount here at your grand total will be different. And so that's what's based off the 75-25 rule, is that forgivable amount. But just gives you the ability to fill out per week, and then you kind of calculate what your grand total forgiveness amount could be. And then you're going to scroll down and you're going to look at your reductions. And so we talked about the 75-25 rule, the 80% and the 20%, and that comes from the payroll costs versus what you spent on other eligible forgiven expenses. So we've kind of met that rule, so we're good there. But then you're going to look at your FTEs, and this is where we kind of wanted to show you that you're going to have to go back and pull some numbers. And so whether you're using option 1 or 2, I would recommend you go ahead and do both to make sure that you're going to not have one better scenario versus the other. And so we've pulled our numbers into here, and I just want to kind of show you how the calculator works. So as of right now, you can see in line 49 there, we have 40 employees as an average for our FTE in our covered period. Option 1, we had an average of 41. And so in that scenario, we are not good, but we get option 2, which is 38. And so we had 2 more than what we're allowed to use in option 2. But I want to change this number real quick to show you kind of how this works. So now our average, after putting 10 in there for our very first week, is 36 for our 8-week period. And that is lower than both options. And so now this calculation takes into effect the best possibility, which would be the 36 divided by the 38 minus 1, which would then give you a reduction amount of approximately $6,000. And so, but it's going to be important to do these FTE assessments. And then you get to the kind of the hard part, and I actually had to create a second tab because it's a little bit more in depth, but it is the example of that 25%, not greater than 25% reduction calculation. And so it's going to pull back to this screen, and then you can see for this example, we had $150,000 spent, so the max amount of the loan proceeds we spent it. We did it appropriately at the 75-25 rule. We have calculated our FTEs, and in this scenario, we have a reduction based on our FTEs of $6,000. And then we also have a reduction of that same $1,500, which is in our example here, our calculation. And so switch back to the first tab. You can see the total reductions of our forgiveness is about $7,500. And so kind of working from top to bottom, this is your now, after your reduction calculations, the max amount that you can be forgiven. So in this scenario, we should be prepared to pay back the difference between $150,000 versus $142,540. Or excuse me, $142,540. Sorry. So we will definitely provide this. It'll be up on our website. We've worked hard to try to make this as easy as possible for our clients and prospects, but definitely going to take some legwork, especially down here. You're going to know your option 1 and option 2. Those can be already calculated, as well as this 25% reduction per employee tab. This can be done as well. The only thing that we would kind of work with you all, or you'd be able to do yourself, is to get a good basis of an estimate of what you think your year-to-date wages would be at the end of your 8-week period. One way to look at that is just to take your first quarter wages over here, your $10,000. We know there's 13 weeks in that first quarter, and so you could take the $10,000 divided by the 13 to get your weekly average, and then take that times 8 to get what's going to be earned over your 8-week period, and then add that to what you made as of your loan origination date, and that'll get you your amount earned during your cover period. So that's one way to kind of go walk yourself through what's this going to look like for me at the end of the 8 weeks.
Yeah,
One
it should
thing,
give you the ability to play with it and kind of see what shortage you have and if you can rectify it in that time frame. And that's why we felt like getting this tool out pretty early is important, because if you get to the end of the 8 weeks, there's nothing you can do about it. So you've got to be proactive and look at it ahead of time.
correct. And so we'll definitely get this shared. I see lots of questions in the chat right now, so we'll try to get there. I know we're coming up on 11:45, so we're getting ready for the Q&A portion, but just wanted to make sure that you guys can see this and kind of walk that through and how the spreadsheet would work. And we'll make sure you guys get your hands on it as soon as possible. I'm going to go back to the PowerPoint here real quick. So we kind of walked over the spreadsheet. And so in conclusion, I just know there's, and please, Lisa, chime in if you can't see the slides, but key takeaways, spend the entire amount of the loan proceeds. Obviously, we do know that looking at the CARES Act, there was definitely intent to get employees funds. And so you can kind of look at that from two angles. One is you can look at it from this 25% reduction calculation and see that they're definitely gearing it towards trying to get funds into employees' hands to come out of this downturn a little bit quicker. And the other part of the CARES Act, you can talk about the unemployment, whereas if you're going and drawing unemployment, you're getting an extra $600 on top of what you were making. So in both scenarios, you can kind of see a theme throughout the CARES Act of these additional funds getting out into the economy to try to turn it around as quick as possible. So we would recommend to spend the entire amount of loan proceeds and plan to do that. Make sure at least 75% of the loan proceeds in this scenario, if you use all of them, are spent on payroll costs. If you're not going to use all of them, just make sure the amount that you did spend was 75%. That way you don't get any reduction with that rule. And then complete your FTE assessment, and then complete the wage reduction assessment as well. And both of those are going to be key components to look at going forward. With that, Lisa, before we go into questions, do you want to add anything or?
I don't think so. You'll see both of our email addresses. We're happy to answer questions. That's really, we have a joke around here. We've really not done tax returns in a long time. This is what we've been working on. So feel free to send us an email, and we'll definitely get back to you. We're going to definitely hit, I see we've got at least 40 questions, it appears. So we'll look at those. We did this same webinar last Friday, and I think we had 50 some questions. So they also are posted with all the answers on our website, so you can also refer to those. And then I believe we will send out the tool and a recording. We can send that to the participants that we have registered on here today as a follow-up as well. So we definitely will be providing that. And again, once we get further guidance, we can always do an update webinar on what has changed to keep everybody abreast. But because there is so much planning involved, we feel like we'd rather get something in everybody's hands so there's no surprises at the end of the 8 weeks based on what we know right now. And hopefully the clarifications will only help us. Hopefully, I think we've taken a pretty conservative approach in the calculations. So I would hope that anything that comes out is only going to help us meet these requirements. Matt, I think you'd feel the same way about that.
I do, 100%. It's definitely, we're reading it for verbatim of what the CARES Act had stated in the statute. And so I know there's a lot of information out there with inferences and just kind of opinions of how it'll work. But we really kind of wanted to just go back to the plain Jane verbiage of what's in the CARES Act and the interim final regs and come up with what we can help advise our clients on at that point.
All right, I say we dive into some questions. I'm sure that'll foster a lot of conversation or things we missed that we didn't think about mentioning.
For sure. So I'm kind of looking through here. I'm just kind of start at the top and work my way down. If I do miss one, I do apologize. Like I said, we'll have a FAQ and we'll get those out to you as soon as possible. The first question here, Lisa, what do they define as utilities? There are many interpretations to company structure, insurance, transportation, hiring fees, and software programs.
So
but you've kind of
they have not technically defined it. I think without question, electric, water, gas, sewer are no questions asked. Those are going to qualify. I feel pretty confident in advising clients that telephone and internet should qualify, but we are waiting on guidance on that. Questions is cell phones, garbage, trash, and we don't know. There's been so little clarity given on that. It just says utilities. So we really hope as soon as this final guidance comes out, it will better define that. Right now, in my conversations with clients, I'm perfectly comfortable with electric, water, gas, sewer, phone, and internet is where my comfort level is right now. I would like to see guidance on cell phones, and I don't know if those technically seem to meet that utility in my mind, but that's just a personal opinion. Matt, I don't know if you feel different or if you've seen any other items.
No, I definitely feel like that conservative approach is appropriate. I do know, I think I've even seen for like construction industries that gasoline or fuel was also considered part of utilities in one spreadsheet I saw. So there are a lot of different things floating out there. Like we mentioned, we just really do not have that definition yet of utilities. Next question here, are ESOP contributions included as retirement plan costs?
I have not seen anything on that. I think the way it reads is just employer contributions to retirement plans is really it's very, very little detail on that. So I'm just gonna be honest and say I don't know. And that is such a specialized area. I'm not even sure that I would expect that to be in the final guidance. We probably would have to look maybe to an ESOP professional and see if what their comfort level is with that. But I get it. I think that you could, in a gray area, think it is, and hopefully we'll get some professionals in that field that kind of weigh in on that. But I have not. There's been nothing released that would make me feel super comfortable with that yet.
Can you include workers' comp costs in your group health care?
So my belief is no. I know some states workers' comp is a little bit different. We're based in the Kentucky area, so I feel confident in saying no from a Kentucky standpoint. Some states workers' comp is a little bit different and based and calculated differently. So I think there maybe is the availability of that in some other states, but every guidance that I've seen locally, that is a no.
And then I'll kind of answer the next one here. Are payroll costs based on paid or incurred? And then the actual statute, it mentions both of those words you just stated, paid and incurred. And so we feel pretty confident about it for sure being things that are paid, but we're still waiting on guidance about costs incurred and how they're defining that. But in terms of planning, we have taken it kind of like Lisa had mentioned earlier as a cash basis type scenario.
And that'll be important to watch for guidance on that, because that's going to dictate if you've got an accelerated pay date at the end to help you meet your payroll cost goals.
Next question, what if you are self-funded for medical and dental? Can claims paid or accrued expenses be included?
We had that with a client. We felt comfortable doing that. There is no technical guidance out there for that at this point. But we were at a comfort level of those costs being counted as a group health cost. You're paying those in lieu of premiums. So I just don't really see how there could be an argument there. So we were perfectly comfortable filling out an application with that way.
Next question here. It looks like we answered the first part. And then we laid off about 75% of our staff in late March. I understand that if we are back to full capacity with everyone rehired, that we would not be hit with the headcount reduction factor. Is that true? And do you know what date we need to be back to full capacity?
The rule is, it says June 30th. Is that right, Matt?
That's correct. Yeah. June 30th, 2020 is when you have to have them back. But then that's not going to really help with your 25% wage reduction factor. And so you're going to want to try to bring them back as soon as possible to start paying them the wages.
Or
at least there are a few other.
It doesn't really help
What's
you.
that?
You've still got to spend the money on payroll.
That's right.
Yeah.
Yep. So it'll help you in one aspect, but then kind of not help you in the other.
It's a three-pronged approach at calculation. So it looks like it relieves you of one, but you still got those other two hurdles, which technically may be the harder hurdles to prove your spending. So we would like to see some further guidance on that, on what the intent was, because if the intent was just to cure the FTE amount, it doesn't really help you. You're still going to have, if you've not spent the dollars, it's going to be hard to get 100% forgiveness, in my opinion.
Question here states 100% can be used on payroll if need be, correct?
Sure. I think 75 is the floor.
Yeah.
Was that how you see it, Matt?
Yep, 100%. Yep. You can.
So if you did, I think I mentioned earlier, if you filled out your application based on the guidance at that time, but now you realize you could have included a lot more costs, you may very well do that. I know I have some clients that filed on the first day, and guidance out there was having you subtract sums. So we feel like they will definitely spend more than 75 easy, because our application was a little bit low on the front end, which is a shame, because there's not been any way to remedy that after clarification came out. So we tried as hard as possible to get some of our applications updated, but there were a few that got filed under the original guidance, which was a lesser amount. So I guess the silver lining is you should meet the forgiveness very easily if that's the case.
I'm going to try to jump through here a little bit and catch some questions that catch my eye here. One question here: what advice would you give to a high turnover / low wage type of industry during this time?
It's going to be tough. The guidance that is not real clear, the last prong that we looked at in the calculation is, that 25% reduction. Well, what if that person's no longer here? They really haven't. I don't feel like that if that FTE has been replaced by somebody else with a similar wage, I think there's going to be some way that we calculate that, and that doesn't hurt you because of that. But I think when you're in a high turnover, it's just going to be managing that FTE count and that 30-hour, just doing your scheduling to cover that 30-hour. One approach I've also heard in meeting that last test of the 25% reduction is providing some sign-on bonuses to get people back working, and that will help you. If you're paying them that sign-on bonus to get started, it's going to help you meet that 25% reduction as well, because you're getting some more money out to them early. But I really think hours and scheduling are really important, depending on your trade. I know we have some construction clients and we have some restaurant clients that are upping the pay rate during this time. So let's say that they're a $10 hour, they may be raising it to $12.50 because they know they need it to meet this forgiveness rule. But it also, they've kind of been tagging it as hazmat pay, just because if you're working maybe more in a public environment that your employees are more exposed, that gives you one way to help you meet that last goal and incentivize your workers to come back, because I know that's a little bit of a concern too. Matt, anything else you have on that?
No, I think you covered that pretty extensively. I guess we have maybe time for one more question, so I apologize if we didn't get to everyone. I've been trying to read through here, and pick some good ones. And so one question I think that I've seen 2 or 3 times is potential. There was one question that talked about, at least I'll kind of gear this towards you here, but the 2019 profit sharing contributions were not made until our covered period. Would that be costs that would be included potentially?
Yes, I have that same situation on a lot of clients I've seen, and my gut is yes, if we normally pay it during this time, but then again, what it's going to come back to is that incurred and paid. Are they going to try to say that we've got to spread that out, that it covers, a whole year, and we can only take 8/52 of that? So we'll await further guidance. What I would encourage you to do is don't pay that quite yet until that guidance crops up. And if we see that we can pay it and get credit for the full credit for it, then that may be something we want to do in that 7th and 8th week once we have further guidance.
I would agree with that. Lisa, I know we're kind of here at our hour mark, and so any client closing remarks before we head off for today?
It's just very complex calculations. Hopefully, I think in talking with people that are using the spreadsheet already, once they get a grasp of what they need to track, it's pretty easy to follow. But it just want to get it in everybody's hands and do some planning and just make sure everybody gets the biggest benefit of this loan program that's possible. And it's just going to take some planning and we're just going to have to get in the weeds and work on it. And we appreciate everybody and hope this was helpful. And Andy, I don't know if you have any closing remarks you'd like to finish up with, but we've enjoyed it and hopefully it's been helpful to everybody.
Can you guys hear me?
Yes.
Perfect. Yes. Hey, first of all, thank you all so much. Such a complex subject and such a moving target for all of us. And appreciate your all's detail, especially the sharing of your tools and the access to that. Like you all said, this is recorded, and we will be sharing that for others to hear as well as we'll make the tools accessible to you. So Baldwin, you all are great partners. Cannot tell you how much we appreciate it. I'd encourage everybody on this call, if you're in need, or if you don't have a partnership like that, they are one of the better ones around. So don't hesitate. You've got their email addresses beyond the information that comes out. So thank you all so much for my clients and prospects perspective. Thank you all for joining us. Cannot tell you how much we appreciate you and understand this difficult time. We want to do anything we can to help you all through this process. We'll continue to offer some other seminar series. We've got another one tomorrow as well. So if you haven't been informed of those, feel free to reach out to your producer. If you have any other questions directly, have any trouble, reach back out to your producer and they can get you in contact with the right people. Thank you all and God bless.
Thank you all. Have a great day.
Take care.